Welcome to our comprehensive guide on the regulatory framework for exchange-traded currency derivatives, or ETCDs in India. In this video, we'll break down the key roles of the Reserve Bank of India (RBI) and the Securities and Exchange Board of India (SEBI), as well as the operational rules set by exchanges and clearing corporations. By the end, you'll understand how these entities work together to ensure a safe, transparent, and efficient currency derivatives market. Let's start by exploring the dual regulatory structure that governs ETCDs and why it's so important for market stability. Exchange-traded currency derivatives in India are jointly regulated by the Reserve Bank of India and SEBI. RBI's authority comes from the Foreign Exchange Management Act (FEMA) and the Reserve Bank of India Act, while SEBI's powers are rooted in the Securities Contracts Regulation Act and the SEBI Act. Together, they set the broad regulatory framework, while exchanges and clearing corporations handle the operational rules. This joint approach ensures that both currency and securities aspects are covered, providing comprehensive oversight and minimizing risks. RBI and SEBI provide the statutory framework. Exchanges and their clearing corporations are responsible for the day-to-day operational rules. These include trading procedures, clearing and settlement processes, and risk management protocols. The bylaws of each exchange ensure that all activities are conducted within the boundaries set by the regulators. This structure allows for flexibility and responsiveness to market needs, while maintaining strict compliance with national regulation. Securities Contracts Regulation Act, or SCRA, is a cornerstone of India's securities market regulation. It gives the central government direct and indirect control over stock exchanges, contracts and securities, and the listing of securities. The Act aims to prevent undesirable transactions and ensure orderly trading. It defines what constitutes a security, including shares, bonds, derivatives, and government securities, and lays the groundwork for the legal validity of derivative contracts traded on recognized exchanges. Under the SCRA, the term securities covers a wide range of financial instruments, from shares and bonds to derivatives and units of investment schemes. Derivatives themselves are defined as contracts whose value is derived from underlying assets like debt instruments, shares, or indices. This broad definition allows for a variety of products to be traded on exchanges, provided they meet the regulatory requirements and are recognized by the authority. Section 18A of the SCRA ensures that derivative contracts are legal and valid if they are traded on recognized stock exchanges and settled through their clearing houses. This provision overrides any conflicting laws, giving certainty to market participants. It also specifies that such contracts must be between parties and on terms notified by the central government, ensuring transparency and legal enforceability. Coordinate the regulation of exchange-traded currency and interest rate derivatives, the RBI and SEBI formed a standing technical committee. This committee was tasked with developing norms for trading, eligibility criteria for exchanges and members, and ongoing review of product design and risk management. Its recommendations laid the foundation for the introduction of currency futures in India, ensuring that the market structure supports both innovation and stability. The committee's mandate included coordinating the regulatory roles of RBI and SEBI, suggesting eligibility norms for exchanges and members, reviewing product design and risk measures, and recommending surveillance mechanisms. It also addressed microstructure issues to ensure financial stability. By consulting widely and studying international practices, the committee ensured that India's framework would be robust and adaptable. One of the committee's key recommendations included starting currency futures with USD/INR as the underlying, implementing strict risk management measures, and setting eligibility criteria for exchanges and members. It also suggested a separate segment for currency futures with distinct trading platforms and clearing corporations, and specific net worth requirements for exchanges and members. These steps were crucial in building a secure and efficient market. FEMA was enacted to facilitate external payments and cross-border trade in India, replacing the earlier FERA. Its main objectives are to promote the orderly development and maintenance of the foreign exchange market, and to define procedures for holding, realizing, and repatriating foreign exchange. FEMA applies to all residents and entities in India, as well as Indian entities operating abroad, ensuring comprehensive coverage of foreign exchange transactions. FEMA covers all foreign exchange transactions, including current and capital account transactions, and applies to individuals, companies, banks, and other entities. It empowers the RBI to make regulations, authorize dealers, and inspect their operations. FEMA's reach extends to all branches and offices outside India owned by Indian residents, making it a comprehensive tool for managing India's foreign exchange resources. SEBI Act established the Securities and Exchange Board of India as the primary regulator for the securities market. SEBI's mandate includes protecting investor interests, promoting market development, and regulating market intermediaries. It has the authority to register, regulate, and penalize brokers and other participants, ensuring that the securities market operates in a fair and orderly manner. SEBI issues detailed guidelines for trading, clearing, and settlement of currency derivatives. These include requirements for contract specifications, trading hours, position limits, and surveillance systems. SEBI also sets rules for membership, allowing banks and other entities to participate as trading or clearing members, subject to eligibility criteria. These guidelines are designed to ensure market integrity and protect investors. Clearing corporations play a vital role in ensuring the smooth settlement of trades. SEBI requires them to perform full novation, meaning they become the legal counterparty to every trade. They must also maintain a separate core settlement guarantee fund for currency derivatives and follow strict risk management protocols, including margining and daily settlement procedures. RBI's guidelines for exchange-traded currency derivatives focus on promoting an orderly market. These include defining eligible currency pairs, setting participant criteria, and specifying contract features. RBI also sets position limits and risk management measures and authorizes exchanges and clearing corporations to deal in currency derivatives. Surveillance and disclosure requirements are enforced to maintain transparency. RBI issued specific directions for currency futures in 2008 and for currency options in 2010. These directions cover contract features, eligible participants, membership guidelines for banks, and position limits. They also outline risk management measures and require exchanges to obtain RBI authorization for trading and settlement. These rules are updated periodically to reflect market development. FEMA is a self-regulatory organization for banks dealing in foreign exchange. Established in 1958, it frames rules for interbank forex business, trains bank personnel, accredits forex brokers, and liaises with RBI. FEMA's role has evolved with market integration, now focusing on innovation, benchmarking, and risk management to support smooth market functioning. With globalization and increased cross-border flows, both residents and non-residents face currency risk. The regulatory framework allows participation from all categories of investors in ETCDs, subject to rules under FEMA and SEBI guidelines. This inclusive approach ensures that market participants can hedge their exposures and manage risk effectively. Authorized dealer category I banks can become trading and clearing members in the currency derivatives market if they meet certain prudential requirements. A minimum net worth of Rs. 500 crores, a CRAR of at least 10%, net NPAs below 3%, and net profit for the last 3 years. Banks not meeting these criteria can only participate as clients, subject to RBI approval. D category I banks must operate within prudential limits such as net open position, NOP, and aggregate gap, AG limits. They can net or offset positions in ETCD against OTC derivatives but must comply with exchange-imposed limits for risk management. The RBI may also set sublimits for the OTC market as needed, ensuring that banks manage their exposures responsibly. Residents in India can enter into ETCD contracts as per FEMA and RBI SEBI guidelines. They may take positions up to USD 100 million equivalent across all INR currency pairs without needing to prove underlying exposure. For positions beyond this limit, users must designate an authorized dealer or custodian, who will monitor compliance and report positions to the exchange. Market participants are also allowed to take positions in cross-currency futures and options not involving INR without establishing underlying exposure, subject to position limits set by the exchanges. This flexibility helps residents manage a wider range of currency risks in the global market. PIs can participate in ETCDs under FEMA and RBI SEBI guidelines. They may take positions up to USD 100 million equivalent across all INR currency pairs without needing to establish underlying exposure. FPIs must ensure their short positions do not exceed this limit, and exchanges report their positions to designated custodians for compliance monitoring. FPIs are also allowed to take positions in cross-currency futures and options without establishing underlying exposure within position limits set by the exchanges. This enables FPIs to hedge and manage risks across multiple currency pairs, supporting their investment strategies in India. Eligible NBFCs can participate in designated currency futures on SEBI-recognized exchanges as clients, but only for hedging their underlying forex exposures. They are not allowed to participate in currency options unless specifically permitted, and must follow all applicable guidelines to ensure their activities are strictly for hedging purposes. Standalone primary dealers (SPDs) with prescribed net worth can participate in currency futures as clients or as direct trading clearing members. They may only trade on their own account, not on behalf of clients. Position limits are set for each currency pair such as USD-INR, EUR-INR, GBP-INR, and JPY-INR, ensuring that no single participant can dominate the market. RBI reserves the right to intervene in the ETCD segment to manage excessive volatility and maintain orderly market conditions. Any interventions are disclosed in the RBI's monthly bulletin, ensuring transparency. This proactive stance helps stabilize the market during periods of stress or unusual activity. All users must adhere to position limits specified by SEBI and other regulators. In January 2024, RBI reiterated that users can take positions up to USD 100 million for hedging contracted exposures without proving underlying exposure, but they must have a valid hedging requirement in place. Non-compliance can result in penalties under FEMA. Membership in the currency derivatives segment is separate from other exchange segments. SEBI's stockbrokers regulations specify net worth and deposit requirements for brokers and clearing members. A single registration now covers all exchanges and segments, simplifying the process for new and existing members. Trading members must maintain a base minimum capital (BMC) deposit which varies based on their trading activities. For example, proprietary traders without algorithmic trading need Rs. 10 lakhs while brokers with algorithmic trading require Rs. 50 lakhs. At least 50% of the deposit must be in cash or cash equivalents, and no exposure is granted against the BMC deposit. Individuals seeking trading membership must be at least 21 years old, Indian citizens, and have at least a higher secondary certificate (HSC) or equivalent qualification. They also need at least 2 years of relevant experience, such as working as a partner, authorized assistant, or apprentice to a member of a recognized stock exchange. Partnership firms must be registered under the Indian Partnership Act and identify a dominant promoter group. At least 2 designated partners are required, each with relevant experience and at least an HSC qualification. Any changes in shareholding or the promoter group need prior approval from the exchange or SEBI. LLPs can be admitted as members if they comply with SEBI's financial requirements and their designated partners meet eligibility criteria. The LLP must be registered under the LLP Act, and designated partners must have relevant experience and at least an HSC qualification. Disqualifications for membership apply to all partners. Companies registered under the Companies Act can become members if they meet SEBI's financial norms. At least 2 designated directors must be identified, each with relevant experience and at least an HSC qualification. The company must have a minimum paid-up equity capital of Rs. 30 lakhs, and directors must not be disqualified under SEBI rules. Banks authorized by RBI as AD Category I can become trading and clearing members if they meet prudential requirements, a CRAR of at least 10%, net NPAs below 3%, and net profit for the last 3 years. This allows banks to participate directly in the currency derivatives segment, both for their own account and on behalf of clients. Applicants must ensure that at least one designated director, partner, or compliance officer meets SEBI's certification requirements. Members must also satisfy net worth and deposit requirements, and exchanges may set additional standards for investor service and infrastructure. These measures ensure that only qualified and reliable entities participate in the market. Entities cannot become members if they have been adjudged bankrupt, convicted of fraud, or expelled by another stock exchange. Those engaged in unrelated businesses or debarred by regulatory authorities are also ineligible. These strict disqualification rules help maintain the integrity and reputation of the currency derivatives market. SEBI assesses whether applicants and key management personnel are fit and proper based on integrity, reputation, competence, and financial solvency. Absence of convictions or restraint orders is essential. This evaluation ensures that only trustworthy and capable individuals and entities are allowed to operate in the market. Authorized persons, APs, are individuals or entities appointed by trading members to provide access to the trading platform. APs must meet SEBI and exchange criteria, have adequate infrastructure, and receive specific approval for each segment. This system expands market access while maintaining control and oversight. Both SEBI and RBI emphasize investor protection and market integrity. Guidelines cover surveillance, grievance redressal, and prevention of fraudulent practices. Exchanges and clearing corporations are required to implement robust systems to monitor trading and ensure that all participants act fairly and transparently. Risk management is central to the regulatory framework. Exchanges and clearing corporations must implement margining systems, monitor open positions, and maintain adequate guarantee funds. These measures help prevent defaults and protect the interests of all market participants, ensuring the stability of the currency derivatives market. Clearing corporations are responsible for the settlement of trades, ensuring that obligations are met on both sides. Full novation and daily settlement cycles reduce counterparty risk. The use of separate guarantee funds for currency derivatives adds an extra layer of security for market participants. Exchanges and regulators use advanced surveillance systems to monitor trading activity, detect unusual patterns, and prevent market abuse. Regular audits, reporting requirements, and real-time monitoring help maintain transparency and trust in the ETCD market. The regulatory framework for ETCDs is continuously updated to reflect changes in the market and global best practices. Both RBI and SEBI issue circulars and guidelines as needed, ensuring that the market remains robust, competitive, and aligned with international standards. India's regulatory framework for exchange-traded currency derivatives is comprehensive and dynamic, balancing innovation with risk management. The joint efforts of RBI, SEBI, exchanges, and clearing corporations ensure a secure and efficient market. By setting clear rules for participation, membership, and risk control, the framework supports market growth while protecting all stakeholders. Thanks for joining us on this detailed journey through the regulatory landscape of ETCDs in India.